Ever have that feeling where you're working hard, maybe even earning more than you used to, but your money doesn't seem to stretch as far anymore? If that sounds familiar, you're not alone. Let's dig into that feeling and the real economic forces that might be shaping it. It often starts with something small. You stop at the grocery store for a few basics, milk, eggs, maybe one or two other things. Then you reach the checkout and watch the total climb higher than you expected, and you feel that familiar knot of tension in your stomach. That feeling doesn't stop at the grocery store. Later, you sit down to pay the bills or look over a credit card statement, and the math doesn't add up the way it used to. The buffer in your monthly budget, that small margin for error, feels thinner and thinner. When that pressure builds, it's easy to turn it inward. You start thinking that if you were just more disciplined or made slightly better choices, things would feel easier. But what if that explanation is only a small part of a much bigger picture? What feels like a personal struggle is often a direct result of how our modern economy is built. This isn't about one bad month or a temporary spike in prices. It reflects a deeper change in the structure of the financial system itself. To understand why so many people feel this pressure today, we have to look back. Specifically, we need to look at how the relationship between productivity and pay has changed, because at some point the rules of the game shifted. For decades, there was a fairly simple arrangement. When workers became more productive, when output increased, wages rose alongside it. Productivity and pay moved together in a clear and predictable way. But around the 1970s, economic data shows a turning point. That link between productivity and pay began to break, a shift often referred to as the Great Decoupling. Productivity continued to rise steadily, but pay for the average worker flattened out. The economy became very good at creating wealth, but that wealth didn't translate into greater purchasing power for most families. And on top of that growing gap, several additional pressures began squeezing household budgets. One of the biggest is housing. After the 2008 financial crisis, home construction slowed dramatically and stayed low for years. Over time, this created a significant shortage, with millions fewer homes than the number of families who needed them. That shortage produced a classic supply and demand problem. Then mortgage rates began to rise, jumping from historic lows near 3% to well over 7%. This created what's known as a lock-in effect, where homeowners with low rates had little incentive to sell. For new buyers, the impact was severe. The monthly payment on the same house could nearly double, even if the price of the home itself didn't change very much. Housing costs became a far heavier burden than they had been in the past. At the same time, there was another major shift happening quietly in the background. For many workers, traditional pensions that placed retirement risk on employers were replaced by plans like the 401k. Over time, that shift market risk, investment decisions, and longevity risk onto individuals. Another pressure came from borrowing costs. As central banks raised interest rates to fight inflation, the cost of credit cards, car loans, and mortgages increased sharply. Household interest payments rose at the fastest pace ever recorded in a single year. All of this feeds into a common point of confusion around inflation. We hear that inflation is slowing, yet everyday life still feels expensive. The reason lies in how inflation is measured. Inflation tracks the rate of price increases, not the level of prices themselves. Slowing inflation doesn't mean prices are falling, it simply means they are rising more slowly. Once prices increase, they rarely return to previous levels. Over a recent 4-year period, cumulative price increases totaled about 20%. That increase is now built into the cost of everyday goods and services. This helps explain why certain costs, like housing, feel disconnected from official inflation numbers. Inflation measures don't track actual mortgage payments. Instead, they rely on something called owner's equivalent rent, an estimate of what a home could be rented for. As a result, sharp increases in mortgage payments don't immediately show up in headline inflation data. This creates a gap between what economic reports suggest and what people experience in daily life.
When you put all of these pieces together, that disconnect becomes clearer. Economic indicators can look relatively stable while households feel stretched, and that feeling isn't a personal failure. A higher home value might make your net worth look better on paper, but that value is illiquid. You can't spend it. Higher grocery bills and rising interest payments, on the other hand, are real cash leaving your wallet every week. So when managing money feels harder than it used to, that response is rational. It reflects a structural shift in how the economy works, not a lapse in personal discipline. Stability simply costs more than it once did. The gap you feel between economic headlines and your own experience is real. Your instincts are responding to forces that broad statistics don't always capture well. Understanding those forces can bring clarity and help replace anxiety with perspective. This content is for educational and entertainment purposes only and should not be considered financial advice. I am not a licensed financial advisor. Always do your own research or consult a licensed professional.